All right, in this section, we're finally going to talk about preferred stock and the price round. This is going to be a little bit of an overview. In other sections, we're going to go into the particular control, economic rights that are associated with preferred stock. But let's take a look at the stage financing chart and see kind of where we are on that chart. We're talking about preferred stock round. We're talking about maybe when angel investors might make a preferred stock round at the pre-seed stage, probably not. But when maybe at the seed stage as well, when some early stage VCs, venture capitalists come in and make an investment. But we're definitely looking at a preferred stock investment when we're looking at Series A. At this point in time, we're expecting the ability of those investors to be able to make a reasonable valuation on the company. So at this point in time, we're going to think about a little bit later in the life cycle. We're thinking about when there's a product, there's a service, and maybe there's some revenue. And when we're talking about the capital raised in this round, it's used to scale and grow the business, not start the business. These investors aren't investing in an idea. They're investing in a business. They want to use this money to take market share, to expand the business, to generate revenue. Often you'll hear the preferred stock round, the price stock round denoted by a series. So you might see a series seed, which would be the seed round of financing, and then it'll be followed by a series A, and then another round will be followed by a series B, series C. These names don't really have any specific definitions. They're just kind of what's been used in the industry. Usually when we're talking about preferred stock round, we're talking about anything between $2 million to hundreds of millions of dollars of capital that are being raised, depending on the stage. A Series Seed stage round might be a little bit lower towards $2 million, whereas a Series A would probably be about 5 to 10, even more nowadays actually. And then when you're thinking about the amount that's being invested, and you think about the amount that the investor expects to own in the company after they make this investment. So generally speaking, in a preferred or priced round, an investor is going to want to own between 15 to 30% of the company. Importantly, this round is going to come with some control and management rights that the founders haven't had to deal with before. Like even if they raised a convertible instrument round, that convertible instrument didn't come with control terms or really any management terms. There was maybe some restrictions that were tied to the use of it, but this was basically just money now, investment later, control terms, management terms later as well. And so when we're talking about negotiating this price round, this preferred stock round, we're thinking about this in two stages. First, there's going to be a term sheet that's going to cover the key negotiation points, such as valuation and some other key ownership and economic terms, as well as some control terms. And then the definitive agreements, how the preferred stock purchase agreement, the changes to the charter, which are going to change the rights that the investor receives, as well as a bunch of other documents related to information rights and other ancillary rights that an investor is going to want, both from a management and control aspect as well as from an economic aspect. So really, we're talking about this preferred stock round, this price stock round. We're talking about key negotiation points being ownership that the investor is going to receive and the valuation. So how much does a VC expect to receive based on their investment amount? And in turn, how much are the founders willing to give up? That's the key negotiation point there. That's the key mindset of when you're thinking about this is how much does the VC expect to get for this amount of money that's being paid, and how much does the founders want to give up? However, there's also other economic terms that do impact ownership and valuation, and we're going to learn about those in more detail in the next section, and also management and control rights, which we'll learn even further on in the next section. So right now, we're going to go through some formulas and thinking about and understanding valuation, how it impacts the price per share, how the price per share impacts the percentage that the investor is going to own, and how much shares the investor is going to receive. So as to go back over what we've discussed before, let's understand valuation. Post-money valuation equals pre-money valuation plus an investment. Again, the pre-money valuation is the valuation that the investor is telling the company that their company is worth before they gave their investment. You kind of see this on Shark Tank quite a bit. The post-money valuation is a product of that pre-money valuation plus the investment amount. Right? So if an investor tells you what the pre-money valuation is, then they give you the money, you can add those two things together to find out what the post-money valuation is. You can also use this to figure out how much the investor expects to own in the company based on the amount of their investment plus the post-money valuation. For example, a $2 million investment at an $8 million pre-money valuation. Well, we know from this formula that $2 million being the investment plus the pre-money valuation gives us a post-money valuation of $10 million. So those investors invested $2 million at a $10 million post-money valuation. They expect that their $2 million investment on a $10 million post-money valuation will give them ownership of 20% of the business. So we've been talking also about price per share, right? We talked about in the last section that the convertible notes are going to convert at a discount on the price per share, right? So how do we figure out what price per share is anyways? Well, price per share is the product of the pre-money valuation, which is provided by the investors, divided by the pre-money fully diluted capitalization. We're going to go over what's included in this fully diluted capitalization a little bit down the road here, but let's just say it's all of the stock that's considered to be out there right now. So for instance, let's look at WeWash and Adam and Betty. Adam and Betty own 1 million shares each for a total of 2 million shares. In our last example, the pre-money valuation was $8 million. Let's look at our formula to find out what the price per share is. So we have a pre-money valuation of $8 million and a fully diluted capitalization of $2 million, which gives us a price per share of $4 per share. What does price per share really tell us? Well, we use price per share to help us determine how many shares that the investor will receive based on their investment. So let's take a look at this formula. The number of shares equals the investment price divided by the price per share. So let's look at this example. If TAG Ventures invests $2 million in WeWash at a price of $4 per share, TAG Ventures will receive 500,000 shares. This makes sense, right? We had $2 million of shares outstanding beforehand. TAG Ventures is going to receive 500,000 shares. So there's a total of 2.5 million shares, of which TAG Ventures owns 500,000. 500,000 is 20% of 2.5 million. Let's look back at our investment amount. $2 million is 20% of $10 million. So we can see that the math checks out. They're owning 20%, which is exactly what they expected to have. So let's back up. We talked about how fully diluted capitalization helps us determine what the price per share is, but we didn't discuss exactly what's included in the fully diluted capitalization. So the fully diluted capitalization includes securities that are issuable or convertible into common stock, such as stock options. We talked about stock options giving the recipient the right to buy stock in the future. We talked about how these are awarded under a stock plan. We're going to need to keep those things in mind when we're thinking about the fully diluted capitalization, because those stock options are issuable into common stock. Similarly, convertible notes and safe agreements or simple agreements for future equity are convertible into common stock. And as we'll learn in the next section, preferred stock is convertible into common stock. So what those investors are going to do is they're going to want all of those securities that are convertible into common stock to be included in that calculation early on, so that way those investors aren't diluted based on the later conversion of those securities. Let's look at an example here with bringing in the stock pool, which we discussed earlier. So WeWash has a stock option pool of 500,000 shares. They went in their stock plan and they reserve 500,000 shares. So the fully diluted capitalization before the $2 million investment from TAG Ventures, it was 2 million shares held by the founders. 1 million shares by Adam, 1 million shares by Betty. So now we're also going to add the option pool of 500,000 shares into the fully diluted capitalization, which gives us 2.5 million shares. So what happens? Well, the option pool inclusion there impacts the price per share, right? Because now we have $8 million divided by the number of shares, which is 2.5 million shares. So the price went from $4 per share to $3.2 per share. Tag Ventures' investment of $2 million buys them 625,000 shares of preferred stock. That wasn't the case when we just looked at the fully diluted capitalization, only including the shares of Adam and Betty. But when we bring in that stock option pool, you'll see that the investors get a lower price, and then they also get more shares for that price. So we'll look in the next section of how the stock option pool can actually be a mechanism for negotiating valuation and for negotiating price. So let's take a look at a high level of some of these other control and economic rights, which we'll discuss later on. Other economic rights include this option pool, the investors arguing and requiring the company to either increase or set an option pool so that way they're not diluted by later issuances to employees, which they know are going to be necessary to expand, grow the business, to obtain, retain, and incentivize talent. We're going to learn about what's called a liquidation preference, which kind of gives the investor a bit of a debt-like feature. We're going to talk about the conversion of preferred stock into common stock and when an investor would want to convert into common stock. We're going to talk about anti-dilution protection. We're going to talk about vesting, the vesting of the founder's shares. Perhaps an investor might want the founders to reset their vesting schedules, which we talked about in other sections, so that way they're further incentivized to stay on with the company. Talk about control provisions, some protective provisions. These are basically veto rights that the investor is going to have. In order for the company to do something, they're going to need the thumbs up from those investors. Control rights will also come in the form of information inspection rights, the right to receive financial information, the right to inspect books, the right to have knowledge of what is going on with the day-to-day of the business. Drag along and tag along rights. These are rights of the investor to either force others to sell their shares or the ability to tag along in other shares to third parties. A right of first refusal is very important. It's often called preemptive right. It's the right for the investor to be able to buy more stock in a later round in order to maintain their ownership percentage. So this is an overview of preferred stock and price rounds. And so within the next section, we're going to discuss more of the fine-tuning aspects of preferred stock. But until next time, venture awaits.